Hello, my name is Chuck Carnevale, co-founder of FastGraphs. The objective of this Helpful Hints video is to provide greater insights into how you can utilize the orange earnings justified valuation line on FastGraphs to make better investment decisions, as well as have a perspective of what rate of return you can expect from looking at a company you might be analyzing. With this video, I'm going to provide 3 examples, each utilizing one of the 3 formulas FastGraphs automatically applies based on the company's growth rate to calculate and establish the earnings valuation reference line. With this first example, I'm going to look at a lower growth or slow growth company. I'm using Southern Company here as the example. And I've taken most of the graph apart here. When a company's earnings growth rate is below 3.5%, as it is with, or below 5%, as it is with Southern Company, we will automatically utilize the legendary Graham-Dodd formula. You can Google that to see what it is. That will create the multiple that we apply to the line. In this case, Southern Company, over this time frame, which is 2003 to current, we have applied a 15 multiple to create that line. What that simply means is we take each year's earnings per share and multiply it by 15 to create a point on the graph. And then as I go to each of these triangles on the graph, you'll notice that all of them represent a 15 PE ratio relative to the conforming earnings below. So the first aspect is the valuation multiple that is applied to the orange line. In this example, we're using 15. However, there's a second aspect to the line that often goes overlooked and is one of the primary purposes of this Helpful Hints video. And that is the slope of the line, or how fast the line is growing. In the case of Southern Company, the line is growing at a rate of 3.5% since 2003. So to be clear, if you would have bought the stock precisely on this line in December of 2002, and the stock was touching the line at the end of next year, your capital appreciation would be exactly 3.5%. In other words, it would coincide with the growth of the company. However, it's also important to recognize that this is dynamic. For example, if I change this to a shorter time frame, the same 15 multiple still applies, which is the first aspect. However, now if you bought the stock on this day and it was touching that line, and you held it to this day and it was touching that line, your capital appreciation component would be exactly 2.9% per annum. Now this gets a little muddy when there's moderate cyclicality. For example, if you touched it here and held it to here, you would actually have to take 2 years off of the graph to see what your capital appreciation would be. In this example, by shortening the graph, it would be 3%. So the important part of the line here that I want to emphasize is that it represents a fair valuation multiple that you would theoretically be prudent to pay for the stock. And you can see that, and I'm going to lengthen the graph here, you can see that when you add price to the graph. And you'll notice that the price has this penchant or tendency to continuously track the orange line, and it gets disconnected above or below from time to time. But there's a high correlation to the stock price and the orange line over time in this example. This would indicate that Southern Company appears overvalued based on this valuation reference. And again, remember that this line, the slope of this line adjusts even though the PE ratio is staying the same in all these examples. Here we have a 2.5% growth rate, which means this line is only growing by 2.5%, but we still have the same 15 PE ratio. Now, a simple way to utilize this line in your analysis, as I alluded to earlier, is to look at a company when its valuation is aligned with the line. For example, right here we have Southern Company trading at a PE ratio of 15.1, which would indicate it's only moderately or just slightly above the orange line. So since growth rate over this time frame is 3.8%, and the stock is now trading above that line, you would automatically recognize that your capital appreciation component would be higher than 3.8%. You can check that by going to the performance report below, which coincides with the time frame the graph is drawn, and you'll notice that the capital appreciation only on Southern Company over this time frame was 5%. That is the slope of the orange line plus a little premium valuation that you currently have. With my second helpful hint on how to interpret and utilize the orange valuation reference line, I'm going to jump from low growth to a company that has a history of growing very fast, Express Scripts Holdings. Here I want you to notice that the growth rate is 26.3. But I also want you to understand that we're utilizing now the formula that Peter Lynch made famous, the PE ratio equal to the growth rate, to draw the orange line. So instead of having a 15 PE here, we have a much higher PE of 26.3. As you can see, anywhere I touch the triangle here, it's 26.3 times the company's earnings. But also I want you to notice the much steeper slope. This line is accelerating at the rate of 26.3% over this time frame. Now, what's important here is when I bring monthly closing stock prices, we see that there was a very high correlation between price and earnings until we came to the recession. And then subsequent to 2010, 2011, we've seen a disconnect of price from the orange line, or let me say it differently, an apparent disconnect. However, because this is a dynamic tool, watch what happens to the earnings growth rate as I cut time off of this graph. It's now dropped to 22.6% when I hit the 15-year button. I'm going to drop it to 10%, and now it's 19%. And I want you to notice that the PE ratio valuation multiple is adjusting to the company's earnings growth rate. If I drop it to a 7-year graph, we now have a PE ratio that's just a little above what we saw with Southern Company, but we're still using, because it's above 15%, the P equals growth rate formula. And now we see a much more rational connection between price and earnings when utilizing this length graph. If I drop this down one more year here, we have a 15 PE, and we've changed our formula, which I'm going to cover next, to an extrapolated formula, which is our third formula, which is simply Graham-Dodd extrapolated P equals growth rate formula. So there are two primaries and one secondary formula. But once again, just by looking at this graph and recognizing that the slope of this line is 14.7%, or the earnings growth rate, and it was reasonably valued at the beginning and now it's undervalued, as logic would dictate, you would discover that your capital appreciation is slightly less than the 14.7% because we have low valuation negating the growth that the company achieved. With my final example, I'm going to utilize Johnson & Johnson, and here introduce the extrapolated formula again. So we use two primary formulas, the Graham-Dodd for low growth, the P equals growth rate for high growth, and in between 5 and 15%, we apply a formula that is actually a function of both of these formulas. But I don't want to get hung up on the detail there. The bottom line is FastGraphs automatically applies a 15 multiple as a fair valuation multiple to Johnson & Johnson. But what's different here than what we saw in Southern Company, this orange line now is increasing at a rate of 9.3% over this time frame. But once again, as I cut the time frame down, the growth rate has slowed down to 7. If I go to 10 years, which by the way includes the current year and one forecast, it's not 10 years of history, the growth rate is down to 5.4%. Now when I add the price line, and here we have just moderate overvaluation at the beginning and more extensive overvaluation at the end. So looking at this time frame and utilizing the line, recognizing that the line is growing at 5.4%, I can easily and quickly determine that Johnson & Johnson's capital appreciation over this time frame is going to be higher than the 5.4% thanks to the overvaluation. I checked the performance report and I once again see that capital gain was 6.7% over this time frame. But what's important as it relates to this video is it's associated with the slope of that orange line and the company's price in relation to that orange line. Obviously, if I picked a time when the valuation was lower, the rate of return would even be higher. It now turns out to be the total return is 14.4%, but your capital appreciation component would also be higher because you're buying it at undervalued and then moving to fair value. So when you're looking at these valuation reference lines, keep in mind it has two aspects. It has the aspect of the multiple that is of each year's earnings at the bottom of the graph that the line is used to draw and connect the dots, but it also has a slope which is related to that growth rate. And once you get accustomed to understanding that and you wrap your brain around that, you can quickly look at any company and determine whether or not the stock has generated a rate of return that's commensurate to the company's growth rate. In this example, my final example, I'm going to put United Technologies on here and kind of summarize what I've said and show you how this works. So if I look at United Technologies over this long time frame, I see that it was reasonably or close to being reasonably valued at the beginning of the graph. And then as I come to the end of the graph, it's almost overvalued, or it's just moderately overvalued at this point. The earnings growth rate is 10.3%, and so when I check capital appreciation, I get 9.6%, which closely correlates to the company's growth rate. There's a little cyclicality here. So the point is, the slope of this line from point A to point B is 10.3%, or growth of 10.3%. The fair valuation line is 15. I hope this helpful hint has helped you understand the orange line and how you can utilize it to analyze stocks and attempt to determine what your rate of return potentials might be by looking at any company relative to the orange valuation reference line and the valuation of the stock at the time. This has been Chuck Carnevale saying thanks for listening.